If you are the only director of a company and believe that advancing personal funds later will protect you from GST penalties, you'll want to pay close attention to this case. Hi, I'm Amandeep Singh, CPA and founder of Cloudiverse CPAs. I make videos to help Canadian business owners stay on the right side of CRA rules. In a 2025 tax court decision, Ayoub versus HMK, the CRA held Michael Ayoub personally liable for over $330,000 in unremitted GST owed by his construction company. The company had failed to remit GST on both sold and rented properties between 2014 and 2016. Ayoub tried to argue that he was diligent and even advanced personal funds to the corporation, but the court did not accept it. You see, one part of the tax owing was from 3 homes where GST was collected on sale but not fully remitted. The other part came from renting out newly built homes, which triggered self-supply rules. The court emphasized that even if no GST was collected on the rentals, GST was still due based on the fair market value. Not collecting GST on self-assessment does not protect the director from liability. Ayoub filed most of the tax returns late and also did not make payments on time. He admitted that he was only told by his accountant after the rentals that the GST was due, but by that time it was too late. The court said a prudent person would have checked with their accountant before leasing, especially knowing that the business was under financial stress. The court pointed out that even though he advanced over $400,000 to the company, the money mostly went to cover older tax shortfalls, not to prevent new failures. You see, directors must take steps to prevent remittance failures, not just fix them after the fact. It also did not help that Ayoub focused on paying tradespeople and discharging mortgages while ignoring the government funds which are through GST obligation. The court stated clearly using crown money to finance business operations is exactly what the law is designated to prevent. See, the judge was also critical that Ayoub did not instruct his lawyer to hold back GST on closing or segregate it from general funds. That's the key point. Segregating GST from operating funds shows care and can help demonstrate due diligence, and he failed to do that. The court also rejected the idea that undercapitalization was an excuse. Directors of financially weak companies have an ever greater obligation to plan ahead for tax remittances. In the end, the court applied an objective test and concluded Ayoub didn't act as a reasonably prudent director. Despite personal sacrifices and efforts, the law required a proactive approach that just was not there. If you found this helpful, please like the video and subscribe for more practical tax insights for business owners. Thanks for watching, and I'll see you in my next video. Until then, bye.